Thank you for joining the Frontline Perspectives webinar on the single family rental market. My name is Adler Salomon, and I am joined by my colleague Anna Deriy. We are both senior analysts who cover the SFR asset class at DBRS Morningstar. On our agenda today, we will highlight certain performance metrics over three different time horizons for SFR transactions that we've rated at DBRS Morningstar. We're going to look at the 12 months preceding the COVID epidemic, specifically March 2019 through March 2020, the 12 months after the start of COVID, March 2020 through March 2021. And then we're going to look at year over year performance from March 2021 through March 2022. In addition, we're going to go over some of the outlook we have for the sector, followed by a recap of what we covered here today. After the presentation, we will open it up for questions. I believe the presentation will be sent out in an email tomorrow. And as for questions, you can submit questions at the bottom right of your screen. So without further ado, I'll hand it over to Anna.
Thank you, Adler. First, we'll be looking at the tenant delinquency trends over the last 3 years. As you can see from the chart, the pre-COVID tenant delinquency rate was below 2% for all the property managers in our rated portfolio, averaging approximately 0.6%. As expected, tenant delinquencies have increased significantly with the onset of pandemic due to quarantine, business closures, and subsequent loss of income in many households. The nationwide eviction moratorium protected tenants from eviction for failing to pay rent that came due during the covered period beginning March 2020 through the end of 2021, which also contributed to the overall tenant delinquency increasing almost tenfold to 5.96% from its pre-pandemic levels. This increase was moderated by the direct rent assistance programs, stimulus funds, and increased unemployment benefits. As these benefits expired, tenant delinquencies increased to 6.4% in the 12 months period ending in March 2022. Since the eviction moratorium was lifted end of last year, we expect to see tenant delinquencies to improve as the courts will process the backlog of cases. However, delinquencies will continue to remain significantly elevated as compared to their pre-pandemic levels, driven by the lack of affordable inventory of comparable rental properties, with the supply of single-family housing remaining at historic lows and tenants facing a competitive rental market with rising rents. If you look at the SFR delinquencies by MSAs, you can see that the larger dots represent the amount or number of properties in that particular geographic location. The largest observed delinquencies are concentrated in Chicago, Atlanta, and Memphis MSAs, averaging from 9.7% in Memphis to 11.7% in Chicago. Conversely, homes located in Phoenix, San Antonio, and various MSAs across Florida, including Jacksonville, Orlando, Fort Lauderdale, and Tampa, experienced the lowest tenant delinquencies. Perhaps unsurprisingly, these MSAs tend to be the most landlord friendly jurisdictions, allowing property managers quick resolution times from the onset of delinquency. Moving on to the vacancies. The vacancies in the single borrower transactions showed strong performance over the last years. Pre-COVID year, we have observed 3.9% of vacancy across our rated portfolio, which is generally in line with the longer-term historical SFR trends. Vacancies saw a 1 percentage point decline, averaging 2.9% for the year beginning March 2020. The decline was mostly driven by higher tenant retention rates and higher demand for single-family homes, particularly from urban apartment dwellers wanting to socially distance and have more living space to work remotely. The trend has reversed in the year ending in March 2022, with the average vacancy rate of 3.7, reverting to the historic observed performance of the single-family rental assets. For the coming year, we project vacancies to remain stable as home values and mortgage rates will continue to rise, reducing affordability for the first-time home buyers and increasing rental demand amid tight housing supply. Moving to the um, vacant SFR vacant to occupied rent change on single borrower transactions rated by DBRS Morningstar has markedly risen from the COVID-19 level. The rent change over the last 2 years was the largest experienced for the SFR market to date. The average vacant to occupied rent change observed over the 12 months period preceding COVID-19 pandemic was 3.1%. The average vacant to occupied rent change observed over the 12 months period after the start of COVID-19 beginning March 2020 was 11.9%. The usual vacant to occupied rent change shows seasonality with the higher rent increases charged over the summer and more muted rent rises during the winter months. From the chart, you can see that while the rent growth remained constant in the beginning of 2021, it has not exhibited the usual winter dip as we have seen from the year prior. The most recent winter data does show a decline in rent increases, but the decline is from the peak of approximately 17%, bottoming at 12% and starting to inch up again. The 13.1% vacant to occupied rent change observed in February 2022 is 40% greater than 9.7% rate observed in February 2021. If you're moving to SFR renewal rent change, it is increasing at a slower rate in comparison. The average renewal rent change observed over the 12 months period after the start of COVID-19 was 5.2%, which is less than half of the vacant to occupied rent change. The beginning of the pandemic was characterized by an uncertain market outlook, and property managers extended rent concessions for tenants renewing their leases. You can see the little dip in the beginning of the year of 2020 when the renewal leases actually had more concessions than usual. However, since then, the renewal lease rent change continues to climb to 7.96% in February 2022, which is 1.6 times greater than 5.1% increase observed in February 2021. While some property managers cap their lease increases or extend preferential lease terms for tenants in place, we expect the rent change for renewal leases to continue growing and eventually catch up to the vacant to occupied properties, albeit at a slower pace. Apologies. While we expect a deceleration of the rent growth towards the end of 2022 and into 2023, we will continue to see strong rental growth and collection helped by low vacancy rates, increased demand for single-family homes amid low existing inventory and insufficient new construction. Adler, back to you.
Thank you, Anna. So I'll pick up right from where Anna left off and take a look at blended rate change by MSA as of March this year. For those of you who are not too familiar with our SFR performance report that we publish monthly, blended rate change refers to rent increases or decreases observed from vacant to occupied and occupied to occupied property leases. It does not include rent change from renewal leases. Anna just talked about renewal rent change in the prior slide. So we thought it'd be interesting to see geographically where the largest rent change or rent increases in this case are occurring. In this chart, we're looking at the lowest rate change to the left of the color spectrum in red to the highest in blue. and the size of the bubble reflects the number of SFR assets in each MSA. So unsurprisingly, we find that the largest rent change happened in Las Vegas, Nevada, Phoenix, Arizona. And for the state of Florida, we have Tampa, Orlando, Fort Lauderdale, and Jacksonville. And for Tennessee, we have Memphis and the Atlanta, Georgia MSA. Las Vegas shows the highest blended rent change at 11.7%, followed by Phoenix at 10.9%. And in Florida, we see notable increases in rent in Tampa, Orlando, Fort Lauderdale, Jacksonville, in the range of 8.8% in Jacksonville to 10.8% in Tampa. And we also see Memphis, Tennessee, and Atlanta, Georgia at 9.9% and 9.8% respectively. And as for the average rent change, blended rent change, we see in March for the transactions we've rated, that was 8.4%. We had the same map last year in April when we did the last SFR webinar on performance. And just for a comparison, we wanted to get an idea how much change occurred in the last 12 months. So if we flip back and forth between the current map and last year's, we'll see some of the changes that occurred. So you see here in the current map, as of March 2022, as I mentioned, Vegas and Phoenix showing 11.7% and 10.9% change. If we take a look at last year's map, Vegas was at 9.4%, while Phoenix was at 9.1%. So on average, about 2 percentage point higher than they were last year. And then if we move to the right and we take a look at Florida, Florida was actually not in the blue spectrum yet. Tampa was showing a blended rate change of 5.9%. And if we look at now, Tampa is at 10.8%. We see similar patterns for Jacksonville, Orlando, and Fort Lauderdale. So all these MSAs are actually in blue now. Last year, when we looked at this, they were mostly still in the red. Red meaning the rate change was rather moderate. Now, if we look at some other places like Charlotte, Charlotte was at 6.3% last year in March when we looked at it. Now it's at 8.1%. If we move up a little bit to Nashville, which was at 8.4, now which is now at 8.4, and it used to be at 5.5%. So a lot of notable changes in rent growth for the past year. And if we take a look briefly at Texas, the two big MSAs we're looking at are San Antonio and Houston. San Antonio was at 3.6% when we looked at it in 2021. I'm sorry, Houston was at 3.6 and San Antonio was at 4.9. And now, as of March, we're looking at 6.6% and 7.2% in rate change over the last year. So naturally, with rent prices increasing at the rate that they are, intuitively, it makes sense that retention rates would also increase, and that's exactly what this chart shows. Retention rates increased 4 percentage points from 82% preceding COVID to 86% in March this year. So it makes sense for tenants to renew in order to avoid higher rents fueled by the demand of SF4, SFR, as well as to avoid the moving costs. We saw in the prior slides that Anna showed, vacant to occupied rent change observed in February was 13.1%, while the renewal rate change was at 7.96%. Let's call that 8% in February 2022. So again, it makes sense that retention rate has gone higher. Unless you're buying a house, why would you leave your current dwelling to go somewhere else and pay higher rent and moving costs? Okay, so in this chart, we're looking at home price appreciation in 20 MSAs where we've seen the highest HPA growth in the last 24 months. But first, we'll take a look at the year-over-year HPA realized in March, over March last year to March this year, which was 20.9%. A rather large change over the last year. The average 2-year HPA realized in the top 20 MSAs was 38.7%. 12 of the top 20 MSAs in this chart had a 2-year HPA greater than the national average of 36.2%. Atlanta, the largest MSA by property count that we looked at, had a 2-year HPA of 39.2%. Phoenix and Tampa have seen home prices increase more than 50% in the last 2 years. And Las Vegas was at 38.8% for the last 2 years. In June 2021, we did a webinar for the multifamily and SFR sectors, and we talked about how household formation was depressed by the Great Recession, and that the COVID pandemic depressed household formation even more. So as a result, new home inventory was also depressed, which exacerbated the housing shortage now that household formation has ramped up again. This low supply of housing has increased home prices to incredible levels, as this chart shows, which priced out a lot of first-time home buyers, so they resort to renting the home that they couldn't afford to buy. Though rent growth has risen to incredible levels in many parts of the country, it's still cheaper to rent than buy for a lot of first-time home buyers, particularly now that mortgage rates have increased so much in the last 3 months or so. So in terms of deal issuance in the single borrower SFR sector, and recent trends that we're seeing as we rate these transactions, it's been an incredible ride since inception, and we probably saw the peak in 2021, as the chart describes. Issuance in 2021 was the highest since the inception of the SFR sector. Issuance volume for 2022 thus far has been strong. I think we have somewhere around 11 rated transactions that have been issued, with more in the pipeline. And I think a lot of these transactions were pushed through at the beginning of the year in anticipation of interest rates rising. So perhaps the second half of 2022 could see lower issuance volume if the rate sell-off continues. We think 2022 issuance will probably exceed 2020's volume, but fall short of 2021's volume. So in terms of participation in the sector, we continue to see new sponsors in both new sponsors and repeat sponsors are still committed to and bullish on the sector. In January, New Residential issued their first SFR transaction. Prior to that, we saw Starwood. In 2020, we saw Firstky issue their transactions, and now they are a regular participant in the market. Not to mention the M&A activity we saw in the sector in the last couple of years. So this brings us to the DBRS Morningstar outlook for the sector. We have a strong outlook for the SFR sector, and we expect demand for SFR for SFR homes to remain steady. And that demand is obviously supported by the housing shortage, high HPA, and the recent rate hikes. We expect the low inventory to persist. At the IM and SFR conference in Miami, build to rent was cited as a mitigant to the home supply issue. We think that although build to rent might be a viable mitigant, we see some risks related to that initiative, particularly the possibility of a wave back to the office, as some employers force employees to do so. The other risk we see is the concentration issue, where you have a lot filled with single family houses at the same location and probably exposed to local or regional economic headwinds, which would make selling these properties in a default scenario more difficult and probably entail bulk sales at discounted prices. And cost to build may be also a deterrent in the environment of high inflation and labor shortage. Although I heard earlier today that lumber prices have crashed about 60%, so maybe things could be moderating a bit. But overall, anecdotally, I heard cost of building is up by about 30%. To continue, we expect entry-level home buyers to continue to be priced out due to HPA and recent rate hikes. We expect home prices and rent growth to start to normalize. That means single-digit growth and low teens growth rates for both HPA and rent in some of the really hot MSAs, as opposed to the mid-20s to low 30s growth rates that we've seen in the past year or so. And from our perspective, rent growth is obviously fundamental to the sector. However, we have some concerns with regard to rent affordability, because we think that consumers continue to experience inflationary pressures, whether it's from the gas pump. I think fuel inflation was somewhere above 80%. There's food inflation, in addition to the housing prices they have to contend with. Also, there's also the prospect of an economic recession. So we just don't think that rent growth will be sustainable if they continue at the rate that they are. But what gives us some comfort is that deal performance remains strong. The rent to income ratio on average is still well below 30%. Although there are some spots where they are either at or close to 30%. The fact that on average we're still well below 30% and unemployment is still low, I think those factors bode well for the industry. We just think that rent growth must be incremental, not a shock to the tenant. Otherwise, a tenant who gets a lease renewal might not be able to afford the new rent, which leads to delinquency. So tenant underwriting becomes very important in this environment. As I mentioned earlier, we expect deal issuance volume to soften in the second half due to rates, and also obviously what the Fed does. We expect inflation to remain a burden for the macro economy. Depending on the Fed's hawkishness with regard to raising rates, we might see a mild recession. But again, that's completely dependent on how aggressive the Fed becomes. The other outlook, or at least perhaps a cautionary bullet point here, is the potential headline risk relating to rent growth in some states or particularly in some MSAs. There are voices already that have gotten louder about rent growth, and some politicians have already started weighing on this issue. So we think this is something that the sector participants need to be mindful of. So to recap, We think that fundamentals of the single-family rental sector are sound and are expected to hold up well in 2022. We talked about tenant delinquency in Anna's first slide, which have risen since the start of the COVID epidemic, but have been mitigated by low vacancy rates and high retention rates. Occupancy and collection rates remain high. We said that rent growth is high, but maybe unsustainable at current growth rates. So we expect some normalization there. And rent affordability remains a concern due to inflation pressures on tenants and the prospect of an economic recession that looms. So we'll open it up for questions if the participants have any. Okay, I think we have a question. Can you provide an insight into your HPA stress case view forecast? What can you say regarding SFR operators, cost structures, i.e., how does it translate into DSCR? So some of the trends that we've been seeing in the new transactions that we've been rating, we've seen increases in operating costs. So obviously, property prices have been have been increasing quite aggressively so sponsors are buying these properties at high prices. So which is one of the reasons they've been raising rent. But also what comes with that is the property taxes that they are paying on those houses because for obvious reasons. So we've been seeing property taxes in terms of the expense portion of their net operating operating income, which has been eaten away by property taxes, as well as capital expenditures. We've seen an increase in that area as well. Obviously, cost of labor has gone up, cost of materials have gone up. So those two items have significantly affect DSCR, and that's been somewhat of an issue. And in addition to that, you obviously have rates going up, and as a result, bond coupons have been impacted. So DSCR has been greatly impacted by those events. We also see we also see in some of the transactions that we've rated, the advance rates have been falling as operators or issuers try to structure their deals. Because of the widened coupons, they have to sort of lower their leverage on some of these transactions. So we've been seeing advance rates as well as DSCR falling as well. We know that there is a broad sentiment in the market that a recession is likely, but it's obviously dependent on how the economy fares in response to what the Fed does. So we think if we fall into a recession, it'll be somewhat mild. And two of the reasons that we think so are because one, unemployment rate is very low, and the consumer balance sheet is it's pretty sound, unless they go into consumers go into a spending spree, which would force inflation higher and the Fed to react. We think that even though we expect a mild recession, even though we expect a recession, it would be a mild one if one materializes.
There is another question. Have you seen any changes in SFR operators' management fees? Well, the SFR operators management fees are spelled out in loan agreements, and usually they range anywhere from 5 to 8%. So they are unable to go above the pre-specified fee as per loan agreement. So far we have not seen market changes as far as what the property managers are charging.
We thank you very much for participating in this webinar. We will be emailing the presentation to participants, I think tomorrow. So Anna and I thank you very much again for joining. Have a good day.
Thank you.